sir. Ajit sir ji.
Good evening, sir ji. Good evening. How are you?
Fine, sir. Fine, sir.
So good evening to all the members of the Jodhpur branch and the other members who have joined this VCM from other branches too. Jodhpur branch of CIRC of ICI and myself, CA Abhishek Soni, secretary of this Jodhpur branch, welcomes you all in this VCM. We are doing the VCM fourth in the row. So there is an overwhelming response from all the members. And so Jodhpur branch thankful to you to see this VCM, all the VCM, past VCMs patiently and in good manner. So today the VCM on the international taxation and the Indian transfer pricing regulations topic. We are organizing this VCM and we have the guest speaker, CA Ajit Kumar Jain sir. So I heartily welcome to the sir in this VCM that they have given their valuable time to this branch and to their members. Thank you, sir, for coming in the VCM. I also welcome all the managing committee members who are joined the VCM, CA Surinder sir, Lunawat sir, the chairman of this branch, all the members, senior members and my friends. As we know that due to this COVID, we're not organizing the seminars and conferencing in the physical mode. So we are doing VCM on the digital mode. So on this digital platform, we are organizing our various VCMs on the various recent important topics. So our learnings and the knowledge get enriched and get benefited from the various prominent speakers who have joined us on this VCM. Because I have this quote, you don't have to be great to start, but your start have to be great. If you want to start anything, you just don't to be a great person, but your start should be a great always. So this topic, that is the international taxation, because the businesses have no boundaries right now. Any person in any country sitting elsewhere can do business in anywhere in the corner of the world. So there's no global boundaries now to do the business. And for this, there's a various complexities coming in the taxation field that we have to be resolved. For this international taxation and the various transfer pricing rules, we have to get updated because the clients are doing business globally right now, and they're getting some complexities in settling the taxation issues. So we need that expert who can resolve all these kind of issues. And for that, we have very good knowledge about it. So today's topic isn't on the international taxation part. So we can update our knowledge regarding the various changes coming in the recent time by the government and the foreign entities. What are the agreements and all? So our guest speaker will tell this thing in elaborately manner. So we'll get benefited. So I now request CA Surinder Lunawat sir to have a few words for today's session. Over to you, sir. Surendra sir, can you hear me, sir?
Sir, I am audible?
Yeah, sir.
Yes, sir. Today's speaker, CA Ajit Kumar Jain, Secretary, Jodhpur branch of ICI, CA Abhishek Soni, Sikasa Chairman, PA Dhaval Kothari, past Chairman Ritesh Bhutra. Hello friends, good evening to all of you and very warm welcome in this today's virtual CP meeting. I also welcome on my own behalf and on behalf of Managing Committee of Jodhpur branch of ICI, CA Ajit Kumar Jain, who will deliberate on subject basis of international taxation and overview of Indian transfer pricing regulation. Subject is very important for all of us, as nowadays our clients are involving some way or other in international transaction. I hope we all will update our knowledge from faculty like CA Ajit Kumar Jain, who is regularly dealing with this subject and conducted so many webinars. He is a regular faculty at so many forums. He is presently working at UAE with a consulting firm, and he is dealing the matter like international transactions. So I hope you all will get the benefit by such a nice faculty. I am thankful to CA Abhishek Soni for getting touch with CA Ajit Kumar Jain and finalize the today's program. I am thankful to all managing committee members and our technical team for their support. Jai Bharat, Jai ICI. Abhishek ji, over
Thank
to
you so
you.
much, sir. Thank you so much for your kind words, sir. So, coming to the part on the speaker, I am very thankful to Ajit Jain, sir, that they have given their time for this VCM, and they are currently in the Dubai practicing with the consulting firm. So, for this international topic, we have international speaker directly from Dubai. So, I welcome them on the behalf of Jodhpur branch. And basically he's taking various seminars and this VCM kind of forums on the various forums, so all the members get the benefit from their deliberations, and today's VCM will get enriched all the knowledges and the learnings of all the members. Now I would like to have some few announcement, then we will given the session to our speaker. So for CP credit member, we will take the entry till 5:15. We will take the entry till 5:15. After that, we will not taking any entry after 5:15, because as per institute guidelines, every member for CP credit needs to be in the VCM for 1 hour 45 minutes. So we have to close our entry by 5:15, so it will get complete. And for the attendance, for the CP attendance, we will available the chat box after 6:45. After 6:45, the chat box will be enabled for all the members to put their attendance, and they have to just send their 6-digit membership number only in the chat box. Nothing else, no name, nothing else required in that. You have to just send 6-digit membership number into the chat box for the attendance. So after 6:45, the chat box will be available to you all members. So please be in the VCM for get the CP credit. And I also want to announce that if any member not able to get into the VCM by 5:15, they can watch us on live on the YouTube channel of Jodhpur branch of CIRC of ICI. And the members who are presently in the VCM, I request all the members to subscribe our YouTube channel for any important announcement, any important VCMs in the coming in the next days. You will get the updates from that channel. So if you get anytime not get in touch with the branch or something, you not get the mail, but if you subscribe our channel of YouTube, you will get the updates regularly. So please go and subscribe our YouTube channel for more updates and info about the Jodhpur branch events and VCMs. So now I would like to request our today's guest speaker, C. Ajit Kumar Jain sir, to make this session forward. Thank you.
Thanks, Abhishek. Thanks everyone for joining this important session. And I would like to thank CA Surendraji and CA Abhishek for giving me this opportunity to present on this very important topic of basics of international taxation and overview of the transfer pricing regulations. Now, I'm sharing my screen here with the slide. Now, before I start the session, I believe that for this kind of session, 2 hours is not enough for this subject, because if you see, huge amount of litigation is going in India for this subject, not only this subject, but each of the topic under this subject. So it would not be a justice to cover everything in 2 hours. But what I'm going to do, I'm going to discuss the basics, since it is the basics of international tax, and majority of this session is focusing on transfer pricing. I'm going to discuss the basics of international tax, and I'm summarizing here with the key regulations of the Indian transfer pricing. Now, before I move on to the slide, I want to discuss what is going on in the current scenario in terms of the world tax policies and the world tax system. There are 2-3 points which is very important before we talk about international tax and transfer pricing. The first point is that how much importance the tax revenue is for a country. Currently, most of the countries are struggling with the fiscal deficit, and tax is a major source of revenue. And one need to understand that countries across the globe and tax authorities across the globe are very much concerned about getting the fair share of taxable revenue when it comes to the transaction. Yeah. So as Abhishek has rightly mentioned, business has no boundaries. Now, tax is a major source of revenue, and the country's economic development depends upon the tax revenue. No country would like to see any kind of tax avoidance, tax evasion, and country would like to see that each country would get the fair share of taxable revenue. Now, if we talk about the international tax and transfer pricing, sometimes it's very difficult to find out what is the fair share of tax revenue for India or what is fair share of tax revenue of US. If there's a transaction between India and US, there are mechanisms available, but there's a huge amount of litigation going on. And if you have seen at ITAT level, there are good amount of logical orders which are coming up, but at a first level assessment, it has been very difficult for the taxpayers to assess, because some sort of ideal principles of international taxation and transfer pricing are not followed at a TPO level or a AO level. Now, this is what, the importance of the tax revenue for a country. Another point is, for a taxpayer's perspective, it is very important to understand for a taxpayer, for a particular any organization, they need to understand, they need to manage their risk, because ultimately any kind of tax adjustment would impact the overall financial. So they need to manage the tax. While there could be differences in terms of what taxpayer compute the fair share of tax revenue and the tax authorities compute the fair share of revenue. But it is very important for the taxpayer to manage the transfer pricing or international tax policy in an efficient way, maintain documentation in an efficient way. And another important point which gained momentum or gained importance in last 5 years is substance. Now, over the period of years, what we see that tax is a compliance subject, but not really. Nowadays, tax is not a compliance subject where we see that on this date you have to file the taxes and that's it. No, when it comes to the international tax and transfer pricing, it's not only the compliance. There are filing deadline in international tax and transfer pricing as well, but it is not a compliance subject. It is more than a compliance. It's a subject where economics involved, accounting involved, tax involved, law involved. There are various things. So one need to see the substance. If any company is entering into a transaction with some other company, is there any element of tax avoidance? Is there any kind of transaction or anything happening which is resulting into a non-substance based things, like there is no economic rationale for a transaction and I'm just routing or I'm just entering into a transaction just for saving my taxes. So substance is gaining important. If you are entering into a transaction, if there's no substance, then there could be a challenge for you. So having said that, with this background, that how much is the tax revenue important for a country, for a tax authority, and how much is important for a taxpayer as well to understand the risk involved in these kind of transactions, one need to understand what is international tax and what is the basics of international tax. So I start with what is international tax. Now, what is happening is there is a misunderstanding in terms of what is international tax. We all say that, okay, I'm working in international tax, this is international tax law. But if you really see, there is no international tax. Why? Because there's no one law which is prevailing across the globe. When we call international tax, so if you see the definition, international tax is best regarded as a body of legal provision of different countries, covers the tax aspect of the cross-border transaction. Now, the right terminology for this is cross-border taxation rather than international taxation, because there is no one law which is applicable all across the globe. Now, there are three elements to the international taxation. One need to understand this clearly, that when we talk about the international tax, there are three elements. One is studying the non-resident provision in the domestic law. We need to understand what domestic tax law says about the international, about any cross-border transaction. Then one need to understand the two domestic laws of two different countries. And I'll come to the example how you do that. And then the third is the double taxation avoidance agreement. So there are three elements. If we join together, this becomes an international tax law regulation. Now, this is an example. If somebody says that what is international tax, and I would say international tax law, international tax is not right terminology. The right terminology is the cross-border taxation. And there are three limbs of the international tax. What are those three limbs? Suppose there is a transaction between India and Singapore, and one need to understand the tax implications. One need to understand the transfer pricing, everything. What will you do? Do we have a one common international tax law? No, we don't have. We have the three limbs. One, what we need to see the domestic tax law of India. What are the provisions? What it says? We need to see the tax treaty between India and Singapore. And then we need to see the foreign countries tax law, Singapore tax law. After analyzing, because we need to see the domestic tax law, we need to see the tax treaty provisions, the DTAA and foreign tax law. After evaluating all these three, then we advise to the clients or whoever it is that considering all these three, your tax liability is this, and you need to do compliance this. So there is, in a nutshell, there is no international tax as such. It is a cross-border transaction, mix of several things. We need to see local tax law, double taxation tax treaties, and foreign countries, foreign tax law provisions. Now, before going into the next session, next part of the presentation, it is very important to understand. Now, as I mentioned, no country would like to see, is there any tax avoidance or tax evasion? And if there is a tax avoidance, there would be a problem for the taxpayer, and taxpayer may face a litigation. Evasion is completely out of the picture, because evasion is not. Now, it's a simple example to understand what is planning, tax planning, what is avoidance, and what is tax evasion. One need to simply understand from a tax perspective. I'm taking a simple example here. All of us, aware about the local trains of Mumbai, and by taking this example, I would like to explain what is tax planning, what is tax avoidance, and what is tax evasion. Now, if you compute from Borivali to Churchgate, okay, or Thana to, just a minute, there's some screen problem. Yeah, so if you compute Borivali to Churchgate, Thana to CST, the one-way ticket, if you see, is INR 15. Now, what you will do, you need to travel daily. What you will do? You will do nothing. You will take tickets daily basis. So what would be your cost? Monthly, approximately 25 days you have to travel. So your cost would be monthly 750. But if you think that, okay, why don't I plan? So if I plan, then my monthly cost would be INR 215, because this is my monthly planning. Now let's understand, when we talk about the tax planning, I'm going to set up my company in some tax haven. Nobody is going to, disallow me. I'm very well open to, open a company in a place where I get more tax benefit, and it is within the framework of the law. You can very well plan. Now let's understand the tax avoidance. So planning is what you are taking monthly pass. Now let's take the avoidance. What is avoidance? Tax avoidance is something which is within the framework of the law, which is something which is within the framework of the law, but you are doing something which is not the intention of the law. Now let's take example of this. There is a concept of return ticket in Mumbai. So you, if spend something, next day you can come back without spending anything extra. Suppose you are taking 15 rupees, one-way ticket is 15. You take a return ticket paying, paying for the return ticket. For if you return on the next day, you are not charged for that because you have taken a return ticket. Now what that person is doing, that person uses this concept for a overall for a monthly basis. Okay, so this is he's doing as per the framework of the law. What the railway regulation says, okay, you are open to do that, but in a tax world, this would be considered as avoidance. Why? Because this facility, return ticket, discounted, where you on the next day you are returning, you are not charged for returning. But that was not the intention of introducing this ticket. Intention was that the people who are going for the one time, they should come back on the next day without any ticket. But this person is using for the whole month and saving some amount here. So that is called a tax avoidance. And now I'm linking the same in the tax world, how people tax avoid. Now, if I am opening a company in a Cayman Island, which is called a tax haven, and where the tax rate is there's no taxes, and this is called a tax haven. But if I'm opening the company there just for routing the investment, there is no economic activity performed in Cayman Island, then this would be considered as a tax avoidance, because that was not the intention of the law. That was not intention of the treaty. Intention was that if there is a tax haven, you can very well go and open your company there, but you need to prove, you need to prove the substance that some activities going out there, and you are using that benefit for the purpose of economic activity and not for purpose of routing any investment where you are saving the tax or like this. So this is a kind of example where when you talk about tax avoidance, still it is within the framework of the law, but that was not the intention of the law. And that's where, when at the ITLT or at the high court level, if you see, you will find that we get a logical orders and we get more clarity. So if taxpayer is avoiding, if taxpayer with intention of tax avoidance doing this, then it would be a problem. But if there is no intention, still there is an interpretation avoidance, then there are remedies available for the taxpayer at a higher level. So this is an example of the tax planning, where you are taking monthly tax avoidance. We are doing some mechanism but that was not intention of the law. And evasion, you are not taking any ticket. So that is something never ever recommended. So that is tax evasion. So simply understand that's the objective. And it is very important to understand before we talk about anything on international tax, because avoidance is something is resulting into huge amount of litigation in India international tax scenario. Now, as I mentioned, why international tax? Globalization, borderless global economy. We have seen in last 1 decade huge amount of business changes, and there are cross-border dealings. Billions of transactions are happening, and tax revenue is most important for any government. And government never want to see any kind of tax avoidance. There are movement of people, there are issues on secondment of employees, there are issues on a permanent establishment, cross-border mergers and acquisitions, all those things happening, and nobody want to see something, some loss of revenue on account of something. So that's why international tax and cross-border tax is gaining important. Now, I would like to add one more thing here, given that the COVID-19 scenario and what's going on in last couple of years, if you see the overall business scenario is changing. Things are digitizing, e-commerce, a lot of online things, fintech, regtech, a lot of new things are happening. Now, do we think that our tax laws or our international tax laws are aligned with these kind of changes which are happening across the globe? No. So what's happening is Organization and Economic Cooperation and Development is, with various countries, with the recommendation of G20 countries, is, working very hard to frame a unanimous a guideline for digital taxation. Now, and that is the need of the hour. We cannot, continue to have same set of tax laws where the business was offline a couple of years ago. Now it is online. You cannot have. We need to have one consensus, and it is not. It will not be resolved by changing something at a domestic level. Something is required at a global level. So OECD is working hard, but a week ago, unfortunately, US has withdrawn from that digital tax talk. Now, what will happen? We need to wait and watch, but this is what the big thing is going to happen, that digital tax is going to come. And then, as I mentioned, that I was talking about the fair share of tax revenue. So if there are digital activities which are happening, then there would be a different mechanism that will be adopted by the countries uh, uh, in their local tax law after getting guidance from the OECD. There will be changes in the tax treaty by using the multilateral instruments. So all these things are happening at a global level. So this is overall why international tax. One need to understand why cross-border taxation. Tax revenue is the most important for any country. But from a taxpayer's perspective, one need to understand that one should not face irrational litigation, and there are remedies available for the taxpayer. Now, coming on to the purpose of the international tax. What is the purpose of international tax? There are four resulting things out of the international tax or cross-border tax law. Is basically taxing resident worldwide income. So as you are aware that India follows resident-based taxation. Any resident's income, whether it is in India or outside India, is taxable in India. If I am a resident of India, my worldwide income would be taxable in India. Taxing non-resident national income. Now, if any person who is a non-resident, any person who is a non-resident, any income which is where the source of income in India is taxable in India. So if I am an NRI, I have a FD interest, it will be taxable in India because of the source of business, source of that income in India. Now that is the two objective where the taxability is determined. The third objective purpose of the international tax is avoiding double taxation. Now there are income which is earned outside India by a resident and on which tax is paid outside India and tax is again paid in India. In order to avoid that double taxation, we have the double taxation avoidance agreement. And with the help of that double taxation avoidance agreement between the tax treaties, it is very convenient for the taxpayer to, or it is helpful for the taxpayer to get the tax benefit for avoiding the double taxation. Taxpayer can get the tax relief. The fourth is avoiding shifting of profit from one jurisdiction to another jurisdiction. Now, this is something happening in not only international tax but transfer pricing. I forgot to mention transfer pricing is a branch of international tax, and I'll take you an example how people avoid shifting of profit from one jurisdiction to another jurisdiction. UAE has no tax, India has tax. People shift profit from India to UAE by using transfer pricing, by using some mechanism, and in some time it is still within the framework of the law, but it is considered as a tax avoidance, and there are mechanisms to compute the tax avoidance. So the first is computing the resident income worldwide. The second is taxing the non-resident national income, anything sourced in India. Third is the avoiding double taxation, and fourth is avoiding shifting of profit from one jurisdiction to another jurisdiction. Now, as I mentioned, there are the three limbs of the international tax law or a cross-border tax law, and one need not to forget that in order to evaluate anything in the cross-border taxation, one need to look and go back to the domestic tax law, which is section 4, 5, and 6. Section 4, we all aware, is the basis of charge, taxability charge. Section 5 is the scope of total income, where we get to know whether resident income is worldwide taxable in India, and in case of non-resident, which is income which is accruing in India or deemed to accruing in India, is taxable in India. And the sixth is residential status. While I'm not covering this topic because a separate session is required to cover these topics, but it is very important that these are the fundamental sections before you analyze anything related to cross-border taxation. Now, one need to understand there are two concepts here to understand the taxability. source versus resident. Now, if we talk about source, the right to impose tax is based on the either relationship of the income to the taxing state. Now, I would like to take a simple example here. Interest on FD. Interest on FD is a relationship of the income to the taxing state. There's a relationship because source is sitting in India, and it is a relationship, and because of that it is taxed in India, even if it is whether it is so in case of non-resident. So there is a relationship of income to the taxing state. Taxing state means India. There is a relationship of income, interest on FD. Now, second concept is the relationship of the taxpayer to the taxing state. So if I am a taxpayer as a resident and I have a relationship with I have a relationship with India as a resident, so the taxing state has a right to tax everything, whether you earn anything in India or outside India. So there is a source concept where I've taken an example of interest on FD, sourced in India, taxable in India, whether it is resident or not resident. Residence-based concept, if I'm a resident in India, whether it's earned in India or outside India. So these are the, I'll not go through, I've already discussed this residence-based principle and source-based principle. One need to keep in mind, and before we start anything, that where is the residence and where is the source. I'll take an example of residence and source later on. And this is the basis of charge. And as I mentioned, we need a separate session to discuss this residential status, resident, not or resident, non-resident. Given that there is a recent changes in the recent budget in terms of the resident and non-under resident, the simple fundamental to understand here is that the worldwide income of resident is taxable in India, whether it is in India or for any resident. If you see the first column, it is taxable in India. Now, and for non-resident, if anything accruing in India is taxable in India. Now, resident and non-order resident is a concept introduced, basically for the people, for NRIs who are returning back to India. And in some cases, what is happening is some NRIs are coming to India and they are controlling their outside business from India. So in recent budget, the provision, there's some amendment where, some people who are coming to India and controlling their business, which is business outside India, then those income, even if it is accrued outside India, is taxable in India. So I'm not going into this. As I mentioned, this requires a separate session altogether, but the fundamental is one need to understand where is the income is arising. For a resident, entire income is taxable, whether it's in India or outside India. For a non-resident, entire outside income is not taxable in India, but if anything accruing in India is taxable in India. So this is the fundamental. I'll move on to the, before I start transfer pricing, I'll move on to the double taxation part. As I said, one of the purpose is to avoid double taxation in the international tax scenario. And there are different kind of double taxation. There are two different kind of double taxation. One is juridical double taxation, if you can see here. And the second is economic double taxation. We'll discuss one by one what is juridical and what is economic double taxation. Now, juridical double taxation is something, one income is taxable in hands of the different two people. Okay. So if I talk about the juridical double taxation, I'm taking an example is that in case of, so one is juridical double taxation and economic double taxation. So I'm taking an example of this double taxation to understand clearly what is the double taxation. United States of America, there is a company providing services to its clients in India, and Indian company supports some back office services. US is providing. Ideally, India provides, but I'm just taking a hypothetical example. Or you can say some R&D services. US providing services to India, and US is earning income from India. India is paying, provide services to clients in India. Now, what is happening is United States of America receiving the professional fee and paying tax in US. Now, when India is a source country where there's a withholding tax is also deducted. Now, what is happening is in both countries, there is a withholding, there is a taxability in US and India. And if we see the total, this is called a total double taxation. This is called a juridical double taxation. Is that same income is taxed twice in US and in India, and that is called a double taxation. And there are the remedies available in the double taxation avoidance agreement. There are treaties of India with various other countries, and the taxpayer can go and take relief from that double taxation avoidance agreement. Now, moving on to the economic double taxation. Now, economic double taxation is where arises in the following circumstances, where resident of one country derive income from sources of other country, and where each country consider taxpayer to be resident in country under domestic tax law. So it is basically imposition of the income in taxes in two or more states in the same taxpayer in respect of the same income. So if there is so this is mainly applicable in case of transfer pricing, where if suppose some adjustment is happening in India and I have a transaction with US, and that adjustment is happening because of some transaction between India and US, that adjustment is also impacting US, and that corresponding adjustment will result into a double tax for US as well. So there are a mechanism for mutual agreement procedure between India and US. One can resolve or map resolution, but this is an example of the economic double taxation, where imposition of taxes in two or more states on the same taxpayer, not in different taxpayer, the same taxpayer in respect of the same income. So this is basically a concept of the juridical and economic double taxation one need to understand. And then, there are double taxation avoidance agreement. Now, if we talk about double taxation avoidance agreement, that is the main heart of the international tax law or a cross-border tax law, because one cannot rely only on the domestic tax laws. One need to have, because it is a cross-border transaction, mutual understanding between the two countries. DTAA plays a very important role in determining the taxability of the various income. And India has a double tax treaty with more than 90 countries. There are bilateral tax treaties and there are multilateral tax treaties. And in that tax treaties, basically various provisions mention about the treatment of any income. So for example, permanent establishment, in capital, and there are various other provisions. So I'm not going to discuss here, because we are discussing the basics part here. In the subsequent sessions, whenever I get opportunity, I'll discuss those DTAA section. But there's a concept of comprehensive DTAA where everything is covered equally for both the countries, and there are limited DTA where specified limit is there for the income for shipping, air, transport, or state, or and gifts as well. So the concept here is that there is a domestic tax law one need to see, there are double tax treaties one need to see, and one need to decide based on the local provision, because the concept here is that whichever is beneficial is applicable, whether it is double tax treaty or rate mentioned in double tax treaty or rate mentioned in the domestic tax law, whichever is beneficial, the taxpayer can go ahead and claim that benefit under section 90 and 90A. There is a section of 91 as well. Now 91 applicable where there's no called a unilateral relief. Suppose there's no tax treaty with one country, so the rate which is beneficial in foreign or local country, that can be adopted by the taxpayer. So this is the fundamentals of cross-border taxation and double tax treaties, and there are provisions in the domestic tax law, there are double tax treaties, and accordingly one need to see the provisions. One of the important part of international tax law is the interpretation of the tax treaties. One need to understand how to interpret it. That is something it is a matter of practice as well, and one need to see along with that interpretation, one need to see the judicial precedent as well. So that is again a very advanced level, and we'll see we'll discuss at a subsequent level, subsequent sessions. Now, before I move on to the avoidance of the transfer pricing session, there are different mechanisms to get relief based on the evaluation of the domestic tax laws and the tax treaty. So the different scenarios, and what are those different scenarios? So the first scenario is foreign income is taxable in resident country despite the tax paid in the source country. Now, some cases the tax is paid in source country and it is taxable in resident country as well. There's no relief available, then it is called double taxation. What is relief? So second point, foreign income is taxable in resident country. Some income which I'm paying tax here, which I earned from UK, but tax paid in the source country is allowed at expense deduction. In India, those taxes are allowed as expense deduction called deduction method. Then another part is foreign income is exempt from tax. The entire foreign income is exempted in India. That is exemption method. You don't need to take credit or expense or it. The first is deduction, where you claim entire tax paid outside India deducted. The other is exemption. You pay tax outside India and claim exemption. And then that there is a foreign tax credit. Foreign income is taxable, but tax paid in the source country are credited against tax payable in the resident country. So that is called foreign tax credit. And there are reduced rate method where the income is taxable but at a reduced rate. So these are the method, and there are separate mechanism to compute the relief under the if there are transaction between two entities, and one if there are transaction with overseas, and one need to take credit of the same in the domestic tax system. Now, this is, the fundamentals of international tax. And before I move on to the next session, any questions so far? Then I move on to because as I said, the major part of today's session is the transfer pricing. And this is something, which is very close to me because I have been working, extensively in this area from last couple of years. And I believe this is something, not a tax subject. This is more of economics, law, accountancy, and this is one of the most important international tax issues in the current scenario. And transfer pricing is available in various countries across the globe. So it is a global concept. One need to understand not only from a compliance perspective, but also from a overall risk management perspective for a taxpayer. Yeah. So let's move on to the transfer pricing part of what is transfer pricing before I move to the real what is the concept of transfer pricing. See, what happens is there have been a significant increase in the cross-border taxation in last 2 decades, and because of that, and when I say cross-border cross-border transaction in last 2 decades between the related parties, and because of that, the tax authorities across the globe very aggressive, because there is a possibility of possibility of shifting profit from a high tax jurisdiction to low tax jurisdiction and take a benefit of the transfer pricing or in India and pay reduced level of taxation. And explain you how people are taking benefit of transfer pricing for reducing amount of tax they need to pay in India. Now, what is transfer pricing? Transfer pricing simply means a price at which goods services are transferred between 2 parties who are related to each other. So transfer pricing simply means any goods, services, or can be intangible also, transferred between 2 parties who are related. So first thing is very clear, transfer pricing is not applicable when there are transactions with third parties or dealing with the third party. Transfer pricing is applicable. Transfer pricing is transfer pricing only when it is entered into with 2 related parties which are related to each other. Now it's a mechanism for pricing the goods. And why transfer pricing is important here? See, I'm taking a simple example. If you are selling something to your to third party, and if you are selling something to your own brother, would you not charge discount to your brother? Yes, we will sell. Or if I'm selling something to my cousin brother, I'll offer him a very discounted rate. I'll not charge him what I'm charging to the third party. That's what the concept is. But in this discount, what is happening is there is a loss of revenue for the tax authorities. Now, how it is loss of revenue? Because when you deal with your related party, the pricing, there is an opportunity for the taxpayer. There's an opportunity for the taxpayer to influence the pricing. If I'm selling something to third party, I don't have that much of bargaining power or influence. I can max say that, okay, this is my price. If you want to take, that's it. I mean, you cannot, take your own decision because it's a both-way decision. But when you are selling to a related party, this decision can be influenced. A product which you are selling to your third party is at rupees 100. The same you can sell to your related party at 100 at only 20 rupees. Nobody can stop you because you're selling to your own arm, you are selling to your own brother, you're selling to your own party. Anyway, at a group level, you're not losing anything. And that's what the concept of transfer pricing is. You are doing this, you are selling at 20, but end of the day, it is a loss of the tax revenue for the government. And government cannot afford, if you are selling the same product, you are selling to 100 rupees to third party, and if you are selling the same to your related party at rupees 20. So that's the problem, which is issue. That's the main issue. And that's where the importance of the transfer pricing is growing. Around billions of transfer pricing adjustments are happening across the globe. And India is the topmost country where litigation is happening and across the world. There has been litigation not only at a lower level, but also at ITAT, High Court and Supreme Court level in transfer pricing. There are landmark cases like Vodafone, like GE, like Sony. There are various cases which are happening not only at a smaller issue, but a higher different issues as well. And I'll explain what kind of issues which these taxpayers are facing, different kind of interesting issues. So that is the importance of the transfer pricing is gaining up. Now, as I mentioned, different country has a different rate. UAE has no tax, India has tax. And there's an opportunity for taxpayer. If there is a UAE related party, I have the opportunity always to shift my profit by selling at a lower rate to the UAE and get the tax benefit in India. Now, moving on to so this is the core objective of the transfer pricing, the concept of the transfer pricing. Now, how transfer pricing is evolved over the period of year. Transfer pricing is introduced in India in 2001. It was introduced in US long back, and it was introduced in some other countries as well. But in 2001, there was a real need of transfer pricing because the FDIs was flowing into India's huge amount of international trade or transaction happening between the countries. So this is the overall how transfer pricing evolved in India. And now in India, transfer pricing is not a nascent state. It is matured because so much of litigation, so much of understanding, so much of different deliberations, different concept which has come up. And that's the reason this subject is still under dispute. And there are various bodies for available for remedy for the taxpayer, like dispute resolution panel, ITAT, Supreme Court, High Court and Supreme Court anyway available, but there are dispute resolution mechanism available. There is a concept of advanced pricing agreement as well, where both CBDT and taxpayers sit together and agree on a price, and then you will not get any notice from the taxpayer that on transfer pricing. So in a nutshell, what is the object of the transfer pricing? To protect the tax base from a tax authority perspective, equitable sharing of revenue between the nation. As I mentioned, each country wants to have the equitable sharing of revenue between the nations. I mean, every country wants to get the fair share of tax revenue, and then no discrimination between M&E and group and independent enterprises. When we talk about the mechanism of the transfer pricing, there should not be any discrimination, because the overall fundamental of transfer pricing has come up from US and OECD. They have come up with a guideline. On that basis of recommendation, it is implemented in India. And then avoiding shifting of taxes for the high for the purpose of tax arbitrage. So the objective of transfer pricing is basically, if we really see, is to streamline the tax policy for the taxpayers and to make sure that taxpayers do not try to avoid shifting of profit from high tax jurisdiction to the low tax jurisdiction by dealing some transactions which are influenced. And I want to take one more simple example. I need a loan. I need a loan, and uh, I'm providing a loan. Sorry, I don't need a loan. I'm providing a loan to my related party based in Singapore, and I'm not charging any interest. And there are instances where related parties have intercompany loan agreement and there are no interest. So that's where the transfer pricing applicable. So transfer pricing is applicable not only in case of the physical, tangible or services, but in case of financial transaction as well. If you are providing any loan to your related party, make sure that you have to have some interest in place, because in a third party scenario, who will provide loan without any interest? And that's where there's a red flag in front of tax authorities, that you justify what is your arm's length pricing. And I'll come to the arm's length pricing, which is the heart of the transfer pricing. So in nutshell, the special relationship between A Limited, which is based in US, if you can see on the screen, and B Limited, which is in India, because of the spatial relationship, there is an influencing opportunity for the India to shift profit, or there's an influencing opportunity for US to shift profit. So ideally both are high tax jurisdiction, but in transfer pricing, the concept is like this. The underlying principle is that to avoid shifting of profit, but we cannot conclude that both are high tax jurisdictions, so there is no issue for transfer pricing. No, because transfer pricing work on an arm's length principle. And I'll come to the what is arm's length principle. So as I mentioned, transfer pricing applicable for the sale transaction, service transaction, financing, and intangible also, royalty and investment transaction as well. So all these transactions which are impacting the overall tax revenue, then and there is a deviation from the arm's length price. And we used to say in the domestic tax law about fair market price. In the transfer pricing, the same terminology is used as the arm's length price. Now in this scenario, when we use the arm's length price, we need to make sure that if we are entering into all these kind of transactions, the pricing should be at arm's length. Now what is arm's length? I tell you, this is the arm's length pricing. Let's understand what is the arm's length pricing. Now, arm's length pricing, if I am entering into a transaction with related party, that is called a transfer pricing. I am dealing the same transaction within a third party, if you can see on the screen, is called the arm's length pricing. So one is the transfer price and one is the arm's length price. So in my earlier example, which I have taken, if you are selling something to your brother, that is called the transfer price, or your related party, that is called your transfer related party. But you are selling the same product, or you are dealing with third party, that is called arm's length price. Now the fundamental of the arm's length price is that arm's length price is not influenced by any relationship. If any product in the market is X price, it always be a X price. It will not be influenced by relationship. But in case of transfer pricing, because it is with related party, it always be there is always an opportunity to influence. Because end of the day, if you're taking a loss in India and shifting something to outside India to related party at a lower price, it is overall benefiting the group. And overall group level, you are getting the benefit, because you are selling something to a place which is a low tax jurisdiction, and the overall net effective tax for the group is lower, then there's no problem, it influences. But in case of third party, it is not happening. Now let's take an example again, a simple example on the transfer pricing, the arm's length principle, how it works. Now a parent company in India, if you can see on the screen, is selling there's a parent company in India, and there's a subsidiary in Dubai. India, there is a tax. There's no tax in Dubai. And the first is the point of normal pricing, and the second in the right side, if you see, it is the arm's length price. Now, in the first scenario, where you are selling something to Dubai at rupees 80, your cost is 60, you're getting profit of 20, you're paying tax at 30%, which is 6. Now, what happened with Dubai? Dubai has a cost of 80, income is 140 because they are selling in Dubai. Profit is 60. There's no corporate tax in Dubai, so revenue is nil. Okay, so overall tax burden of the group is INR 6. If you can see on this screen, INR 6 here. The overall tax burden of the group. Now coming on to the next column, which is the arm's length price. Now what happens is, instead of selling something so in the first, which is the normal price 6 rupees, because you are selling it at 80 rupees. Now arm's length price, had it been a case this product is sold to any third party in somewhere, and you are charging 120 to third party and you are applying the same price to Dubai, what would be the tax impact? Now in this case, your sale price would be 120 because you are selling same product to third party is 120. Your tax in India is 18 rupees because your earlier in influence price it was 80, but the correct price based on the market forces is 180. Your tax burden is 18. Now Dubai is selling again same price 140 and cost it 120 and profit is 20. So again there's no tax because Dubai is no tax. So if you see, the overall tax burden of the group in case of arm's length scenario is rupees 18, and in case of normal scenario 6. So we can say there's a shifting of 12 rupees from India to Dubai by influencing the price, and that is the arm's length pricing, that your transaction with your related party has to be at arm's length price, which is at 120. If it is 80, you will face problem with the tax authorities from a transfer pricing officer. So that is the fundamental concept of arm's length principle. So that's what we have discussed so far, that why arm's length principle, because difference in the tax rate across the jurisdiction, and that's the opportunity to have the arbitrage for the taxpayer. The taxpayer can take benefit of different tax rate and shift profit. Pricing flexibility, that you have the flexibility to sell at a different price, and every government wants to prevent erosion of their tax base. So this word is very important, erosion of the tax base. By selling at 80 rupees, you are eroding the tax base in India, because ideally you should sell at the price which is fair market arm's length price, which is 120. So this is the concept of arm's length principle. As we discussed, there are different concepts here. Arm's length price is price charge in the unrelated party. Transfer price, which is price charge in transaction between two associated enterprise. Now, there's a concept of associated enterprise, what we call related parties. So as we discussed, transfer pricing always between two related party associated enterprise. Uncontrolled transaction, it means the transaction where we compute the arm's length price between two unrelated parties. So if you are computing anything, if you are entering into transaction which are between two unrelated parties, that is called an uncontrolled transactions. Now, control transaction. Now, if we see this example, if you see the left side, it is the controlled transaction because you control the price. If you see the right side, it is a uncontrolled transaction because you cannot control. It is driven by market forces, arm's length price. So that is the uncontrolled and controlled transaction. If you see these question, what is transfer pricing? Pricing of transaction between related party. Transaction, control transaction between related party. What is arm's length price? Price of the similar transaction between related party. What is the main objective? To avoid shifting of profit from one jurisdiction to another jurisdiction. So I'm not discussing here these all questions. We have already discussed so far. We'll discuss quickly, what are the different kind of international transaction, because there is a concept of domestic transfer pricing as well, where it is applicable for the tax holiday units. But I'm not discussing today here. I'm discussing, mainly the fundamental, because as I mentioned, this is a very, very broad topic, and each topic has its own litigation, own understanding, and own complexities. Financial transaction has own complexities and litigation. There are transactions with intangibles. There are also different mechanism adopted. So as I mentioned, I'll not go into each of the example, but I tell the fundamental. I also already mentioned, borrowing, one need to see if there's a lending and borrowing, there has to be arm's length interest. Now, any loan which is taken or transaction, the underlying transaction under loan is the related party transaction. So loan is not the transaction. Loan is a base. The transaction is your interest, which is impacting your profit and loss. So loan is a balance sheet item, while interest is a P&L item, which is impacting your profit and loss. And there we see that there is a possibility of shifting profit, because if I'm providing a loan I'm not charging any interest from related party, then that's created an issue. And suppose in some cases I'm getting the loan and I'm not paying interest. Now in some cases this has also happened, that I am getting a loan and I'm not paying interest. But if you really see, that is not a problem from an Indian tax authority perspective. Tax authority would not challenge you, because had it been a case you pay interest, your revenue, taxable revenue would go down, but you're not paid interest, your taxable revenue is always up. So the fundamental in Indian transfer pricing is that any adjustment which result into reduced level of tax, reduced level of income, taxable revenue, that will not be considered. So as I mentioned, if you have received any loan, availed any loan, if you have not paid any interest, then you are not mandatorily required to add that interest or pay that interest, because that would be loss of tax revenue. And that is a clear-cut provision in the law, that anything which result in the reduced level of taxable revenue, which is not allowed. So one need to see that what is there from a tax-based erosion perspective, whether base erosion is happening or not. If I'm not paying interest, it's fine. I mean, it's not arms, may not be, it's considered as non-arm's length, but it's not eroding my tax base. So that's something fundamental one need to understand. Then there is a transaction of royalty. A lot of companies pay royalties, and then those royalties are paid at a different level: technology royalty, trademark royalty. One need to understand that it is not the transaction, but as I mentioned in the early part of the session, that substance is also important. Transfer pricing is not only about computing the arm's length price based on the third party. Substance is, now I explain you what is substance. I take a simple example of a very hypothetical example, not covering any client or so far. Just there is a Vicks tablet or Vicks Goli we see in the market, and that is Vicks is I believe is PNG group, and that Vicks is, if you see, is a very old product from 1980s. They are or 90s, I don't know correctly when they have introduced. It's a very old product, and suppose they have been paying royalty for the formula of Vicks to the US entity or US counterpart, because US has developed the formula of that Vicks. Now, if suppose they have been paying royalty from 1990s, and today also they are paying the same royalty, that create a substance issue. Because if you have same product over the period of years, why can't you develop same technology in India and stop paying royalty? Because if you continue to pay royalty or related party, it will reduce the tax base in India. So that's what the problem here is, that if you continue to pay royalty without justifying any benefit, tax authority would challenge you. And that's what there is a concept of benefit test. If you are paying a technology royalty, and you have somewhere computed, okay, this is, I'm paying at a 10% my royalty because I'm taking a technology benefit, and the third party is based on some database, I did some research and I did some mechanism which is available in transfer pricing. The third party royalty rate is around I paid 10%, third party royalty rate is 15%. I paid less, so it is an arm's length. It's fine. But what has happened is, you are paying royalty from 15 years, same royalty. Then tax authority would challenge you. How can you pay royalty for the years for the same thing where we cannot see any changes in your product. Your VIX on which you're paying royalty is same as it was before 10 years ago. So 10 years ago, I was paying royalty. Today also I'm paying royalty. You proved it, this is at arm's length. This will not be acceptable because you need to prove the benefit test. What benefit today you are getting? And if you continue to say that, okay, we get this technology, this, but then 10 years ago, you would be getting the same technology. Why would you not develop the same technology in India in 10 years and what benefit? And anyway, even if you don't, develop that technology in India, what you need to understand that every year it cannot be 10% royalty. You have to reduce your level of royalty because you know what technology you are using. So that sort of challenges which are happening, in terms of the benefit test. And this is not only in royalty, this is in case of services as well. Now, as we know, India is a hub of back office support service provider. Okay, and not only India, but also there are countries like Philippines, Manila, Singapore, where companies have set up a regional hub, where the companies set up the accounting, payroll part of the organization in Singapore, and companies from India pay to them for maintaining their accounts, payroll, and everything. Now, this is very interesting that if I am paying for my organization's payroll, accounting, and HR, all work related expense to my related party, which is based in Philippines, where the cost is low. And parallelly, I have 15 people who are doing accounting in India as well. I'm paying for those employees as well. And that's where this challenge happened with the tax authorities, that, okay, you have proved that you are paying something for the services in Singapore, Philippines, Manila, whatever, or Philippines, or the countries where the tax rate is low, or the overall taxes cost is low, per employee cost is low, and you have proved that this is arm's length, and this you are paid at a cost plus 10% or 5%, whatever, and you have proved at arm's length by conducting some benchmarking analysis, and so that's fine. But parallelly, you have 15, 20, or 25 people working in India doing the same thing. So there is a concept of benefit test again here, that if you are paying, then you need to prove that you are getting the benefit. And if you have similar people working in India and same company doing the same stuff, that is called a duplication of services. That is called a duplication of services. And anything you duplicate, even if it is arm's length, it will be disallowed. The transfer pricing officer will disallow looking at your P&L, and in your P&L, if you have expense like accounting expense or whatever, or even not even P&L, they will go into detail of your cost and P&L, and they will find out that there are 25 people sitting in India doing the same stuff which are done by your counterparty, related party for you. This is totally a duplication, and this will be disallowed from an Indian perspective. So this kind of things, and you need to prove that why these 25 people are there, it is a duplication, or you need to prove by documentation that these people are doing some different stuff. So these sort of litigation which are happening in India in the current scenario. And then there are other transactions, and I would like to take one more interesting example in transfer pricing, and which is there's a litigation going across, not only at a lower level but at a Supreme Court level. There are various case laws. And I have written a research paper also on that transaction, which is called advertisement, marketing, and selling, AMP expenses. Now, how it works in a layman's term, how that adjustment, how taxpayer has made an adjustment, and I'm talking a very layman term, so that I can explain, because there's a lot of complexities happen at a different level. Now, what has happened is, I am a FMCG manufacturer and seller in India. I'm manufacturing and I'm selling in India. I'm using the technology of my parent entity from US, and I'm a licensed manufacturer. I'm not a full-fledged manufacturer owning IP. So there is a difference between licensed manufacturer and full-fledged manufacturer. Okay, and manufacturer who actually owning the IP. In many cases, US conduct research, and US gives the technology solution to the Indian licensed manufacturer, and the Indian company use that for manufacturing the FMCG products. Now, what has happened? US is providing technology. US is licensing us. There is an agreement. Okay, on you can start license. You can start manufacturing, and you can based on this agreement, you can start manufacturing and selling. So here it is not contract manufacturing. It is a licensed manufacturing where I'm getting technology, and after that, getting the technology and after paying that royalty, I'm as good as an entrepreneur in India, because whatever loss or profit is there for FMCG, I will bear it. US company has nothing to do. US will just charge the royalty. Now, what has happened is that FMCG company is paying royalty. That FMCG company is incurring almost 15% of their sales as an advertisement expense. And you know, I mean, these FMCG companies in India need to spend huge amount of advertisement, marketing, and promotions expense for, you know, promoting their product, for the brand. Now, one more point here is that whatever product, now if I take an example of simple example of any pharma company, whatever product, say for example of the Gillette FMCG company, the product is manufactured in India, but ultimately brand is outside India. It's not in India. So the brand of that FMCG company is outside India, and it is that trademark and that Gillette is made outside India. It is just licensed. So there is a technology royalty, trademark royalty as well. Now, when we talk about this brand, what has happened is, as I mentioned, the Indian entity, which is FMCG manufacturer, spent more than 15% as an advertisement, marketing, and promotion expense. And they have a huge sales, thousands of crores of sales in India, and of that 10 to 15% is huge. Now, what has happened is, suppose they have a 50,000 sales, crore sales, and 10% is 5,000 crore they have spent on advertisement, 10%, 5,000 crore. And what tax officer come across and said, oh, you have spent 5,000 crores on advertisement. I cannot accept that 5,000 crore, because this is the brand which is legally owned by US company, which is developed by US company, the trademark owned by US company. You are just manufacturing and selling. In a way, if you're spending 5,000 crore in India, you are helping your US company to building their brand globally. So you need to get compensation. You need to get whatever you have incurred excessively in India. First of all, you need to get back the same from your US entity. Suppose I have incurred 5,000 crore and tax officer says, okay, this is not 5,000 crore. You should have spent 3,000 crore. That is fair market price, arm's length price. 2,000 crore is something, it is benefiting to your US company. You should get back the same from the US entity. And if you're getting back the same from US entity, you should also add a markup, because you are in a way providing services to US company as a marketing support service provider. So that sort of adjustment which are happening, and these are the huge adjustment impacting heavily on the FMCG companies. That and there are legal contention, I mean logical argument also. How can an Indian company who's a licensed manufacturer spending huge amount of advertisement marketing spend in India can contribute to the global brand? So does that mean that if global is doing something for a product which is manufactured in India, do we need to pay them? No, that is not the case. So there are argument in favor, there are argument, you know, and against, and there are a lot of things which are going, you know, in terms of this area. And this is going to be very, you know, challenging, that how advertisement expense, and the interesting part is that though that advertisement expense is, and you know, incurred with a third party. So far we have understood that transfer pricing is applicable only with related party. But how notionally tax officer converted this transaction with related party? So there is a concept of notional transaction. Okay. So there is a concept of notional transaction. And when we talk about the notional transaction, the advertisement what spent on the media, that was a third party. The Indian company has paid to third party. But how tax officer converted the entire transaction to a related party transaction, that your notional transaction is that you are contributing to the brand of your parent entity, and you are provided services. So not only you to get back those advertisement expense from your parent entity, but also to add a markup for the services you have rendered. So these sort of transaction related things which are happening. Now, moving on to the, next section. So these are the very fundamentals of the, transfer pricing. Any questions so far, please feel free to, add in the chat box. We can discuss. Otherwise, I'll move to the Indian provisions after discussing the fundamentals of the transfer pricing, what a taxpayer needs to do. And there are compliance as well. I'll discuss, if we have more time on this. Let's move on to the Indian TP provisions. Now, as I said, this transfer pricing regulations are there across the globe, various countries, and there are countries who are introducing transfer pricing, recently as well, looking at the loss of tax revenue, and India is not the transfer pricing is not at a nascent state, it is matured. So these are the sections you can see. I'll not go one by one, discuss each and everything, because it will be too much in one session, but I want to keep the same flow of talking very broadly about transfer pricing provisions, and rather than going each provision by provision, because as I mentioned, this is a very wide subject. It's required a couple of sessions on transfer pricing to understand the transfer pricing and understand each of those provisions. Now, there are mechanism. So there are mechanism to compute the income as ALP. There are mechanism where we can understand who are the related parties. There are mechanism we need to see what are the international transactions. Then there are domestic transfer pricing regulations. Then there is a mechanism of safe harbor provision. Now, this is very important, safe harbor mechanism. Transfer pricing is a litigated subject, and no country wants to punish taxpayer for huge amount of litigation. There are relief mechanism available also, like safe harbor mechanism. What is safe harbor mechanism? Safe harbor is a mechanism where there are certain rates already prescribed, and if you go with the safe harbor rate, and suppose you are a back office company providing services to US, and you are providing back office services at 15%, cost plus 15%. What you decide, you use this safe harbor mechanism, and you take the benefit of safe harbor mechanism, and according to that safe harbor, the rate could be higher, that could be 18 or 20%. But once you adopt that safe harbor mechanism, you will not get a notice from the taxpayer, because you are adopted, you are in the range, you have already accepted the price. Now, if this does not mean that you are adopting something rate which is given by government, that does not prove that is arm's length price, because what has happened is, in 1 year you are getting that rate, and another year you are not. You cannot rely, okay, safe harbor is this, and accordingly your arm's length price would be same. No, safe harbor is different mechanism. It is just a relief where you can just select you can take adopt, and you can carry for the particular year, and you will not get notice. And then there are provision for the advanced pricing agreements, where taxpayer and CBDT can agree on the rate, and that is not safe harbor. That is a rate agreed based on the arm's length mechanism, based on determination of arm's length price. And we'll discuss how you compute the arm's length price, because that is the crux of the today's transfer pricing discussion. It's not appropriate to discuss each of these provisions, because I want to keep the same flow where you will understand the broad mechanism of transfer pricing, including the how you compute, rather than going into each of those provisions. Now, let's understand again, let's come to the part of how you compute the arm's length price. Arm's length price is any income arising from any international transaction between associated enterprises shall be computed at arm's length price. Okay. Now, if you see the three limbs here, transfer pricing, there has to be international, there are domestic transaction as well, but I'm not covering in this session. Transfer pricing, There has to be international transaction between two or more associated enterprises. First of all, it has to be international transaction. I will discuss what is international transaction. It has to be associated between two associated enterprise, and it has to be at arm's length price. These are the three fundamental. We'll discuss what is the international transaction first. So we need to understand what is international, what is associated enterprise, and what is arm's length price. We have already discussed price, which is there in the third party scenario. Now let's understand the applicability. Section 92(1) of the Income Tax Act provides that any income from international transaction has to be computed with regard to the arm's length price. Sale of finished goods by A Limited to B Limited, India to UK, it is an international transaction. Provision of services by A Limited to B Limited. Now, but there's one more explanation here, that any allowance for expense is also covered. So it is not only sale. If you see the second example, any purchase of goods by A Limited from B Limited is again transfer pricing. Payment of royalty by A Limited to B Limited. So this is an international transaction. Now there's one more concept here. So one is income is covered, one is expenses covered. You are selling goods, you are purchasing goods. There is an allocation also, which is also covered under a transaction. Now what has happened is sometimes companies incur joint research and R&D expense jointly. India, UK, Singapore jointly come together, three companies, same group, they are incurring R&D. Now that is called a allocation. That is called a allocation or apportionment of any contribution. Now this R&D facility is a contribution of India, Singapore and Thailand. Okay, so if you are doing some R&D with the three different entities, same group, then that also covered a transaction. Now how you allocate those expense between three countries, fair share of allocation, arm's length, that is a different mechanism how you compute that, but that is also a matter of transfer pricing where you need to compute the arm's length price. So section 92 covers following three components: income like sale of goods, allowance or expense like any expense purchase of goods, cost sharing agreement like this, you are joint R&D. Now, as I mentioned, base erosion, I mentioned earlier, if there is something which is intended to apply to downward adjustment, like I'm getting any loan and I'm not paying interest. So tax officer will not, ask and tell, okay, you have not paid interest, please add your interest and pay less tax. They will not going to do that. So anything which result into a downward adjustment, which is not applicable, and this will not be considered as an international transaction. So if something result any downward adjustment or some price is computed by tax authority which resulting into a lower taxable revenue, then that will not be applicable. Then you have to pay at what exactly the price you are. So I'm taking a simple example. If you see on the screen, ABC Limited purchased goods at 500 per unit from AE in USA. However, it was purchasing the same material 700 from independent party. Whether the ALP should be 500 or 700. So in case the arm's length price would be 700, because the third party price would be 700, and 200 would be the adjustment would be made by the tax authority. That is called the base erosion, and we have already explained that if you're entering into transaction with third party, this is called arm's length pricing. Now these are the very simple example. I'm not going to discuss because we have already discussed. These are the very end. You can see later on. I'll go these questions. Section 92 of the Act is a charging section or computation section? Is a computation section. Charging section is only section 4. Section 92 has no power to charge. It has only power to compute the arm's length price. Transfer pricing provisions should not be applied in cases where the adoption of the arm's length price result into reducing the tax base, as I mentioned about loan, component of section 2, income allowance for expense and cost sharing agreement. Transfer pricing may be different between group company than price would have been agreed between two related parties due to what? Special relationship between A influencing the price. Now, this is all, concept of international transactions and applicability, and, what are the component of international transaction you should consider. And then there are concept of which entities are considered as a related party. Now, somebody would come and tell that I can directly take from the audited financial, because there is a related party disclosure in the audited financial. No, because that is more or less, prepared based on IFRS or accounting standard. Transfer pricing, the mechanism to compute the mechanism to determine the who are the related party is different. And in most cases, it should be aligned. If there's no alignment, then there has to be proper, management representation to be taken from the client. Now, again, if we really see, there are associated enterprises. There is a definition of associated enterprises, and based on that definition, it is determined who are your related parties. And accordingly, the first step in transfer pricing is, is there any transaction between two? Is there any international transaction? Okay, yes, there is an international transaction. Whether that international transaction is between two related parties, then you need to check whether those are associated enterprise or not. So, who are those associated enterprise? Okay, so there are two provisions here under section 92A1. That the first provision is that associated enterprise which participate directly, indirectly through one or more intermediary in the management, control, and capital. So if any entity is directly, indirectly, whether Indian entity is controlling, whether outside entity is controlling India, controlling the management, control, or capital, control of and management of enterprise overall functioning, controlling the decision and the capital, then those are related party. Now, there has been significant litigation. I'm not going to discuss today, litigation around management, control, or capital, but that is a fundamental. If you decide that this is on management, control, and capital, then you are, associated enterprises. Okay. Now, I'm taking this example because the earlier example is pretty straightforward. I'm taking example in respect of which one or more person indirectly or directly, indirectly management control parent company, and there's a management control or capital subsidiary 1 and subsidiary 2. Both subsidiary 1 and subsidiary 2 are associated enterprises because one company is directly, indirectly controlling management, control, capital of both the subsidiaries. So subsidiary 1 and subsidiary 2 will be related party. Anyway, the parent company and subsidiary company anyway related party because there is a capital control. So subsidiary 1 and subsidiary 2 will also be associated enterprises. Now, this is the major concept of management, control, and capital, and one need to see on a broader level basis whether there's a control exists or not. But there is a deemed concept also, which is, other than the main provisions. The main definition covered in section 92A1, which is management, control, capital, but there is 92A2 as well, which is provides two enterprises shall be deemed to be associated enterprise any time during the year satisfy all these 13 conditions. So 92A1, if satisfied, then you are anyway related party, and there is no requirement for 92A2, and that is also litigated at a various court ruling because 92A1 is sufficient. But if you are not able to decide based on 92A1, then you need to go to 92A2 13 condition. And I'm not going to discuss today these 13 conditions because these are, if you go by the law, these are self-explanatory that, how, in what scenarios, some cases shareholding, some cases dependency on the intangible, some cases 90% of the goods is, dependent on some other parties. And so these are the conditions which are self-explanatory. And you can very well understand that how related parties are determined based on these 13 conditions. So as I mentioned, these 13 categories are combined, holding management activity and control, again deemed associated enterprises. So if you see 13 conditions, there are some condition which comes under control. There are some conditions which are under management, under deemed condition as well, and there are some condition comes under the capital. So one need to see and one need to decide whether those are related party as well or not, and accordingly one should finalize that whether the related parties are actually considered, or the transaction is actually considered between the related parties or not. Now I'm taking a very simple example, although I'm not discussed those 13 conditions, but this is a example where we can see in some cases where indirect control exists, and when we talk about the shares, the Indian tax laws prescribe 26% shares for control. So if I am owning more than 26%, both the entities are related party, directly, indirectly, if I am handling. So in this example, ABC and XYZ are related parties because 26% shareholding. ABC and PQR are associated because there's 100%. XYZ and PQR are A because there is a provision in the deemed 13 condition that if one entity owning more than 26% in both the entities, then both these entities become related parties. So if this XYZ and PQR become related party because this ABC is controlling both the entities or holding share 26%. XYZ and STU are related party because again there is these are related party, and again this entity is 49%, so indirectly it is 26%. ABC and STU are related party because there is an indirect control exists more than 26%. So one need to understand these concepts by going by those 13 definitions. And this is the rulings. I'm not going to deal, but this rulings talks about that there are two conditions. One is management control capital, first provision, and second provision is 13 condition. So this ruling says that these are independently. So even if the first provision satisfied, there is no requirement to satisfy the second provision. So section 9, if section 92A1 is satisfied, no need to satisfy the section 92A2. Okay. Now moving on to the next part, which is international transactions. We have already discussed what are the international transactions, because the transfer pricing is applicable when there is an international transaction between two entities, and we have discussed purchase, sale, provisional services, lending, borrowing. All these transactions has to be at arm's length between related parties. So international transaction defined under section 92F, transactions should be between associated enterprises, and either or both of parties should be non-resident. Okay. Any international transaction, any transaction will not be considered as an international transaction if it is between the domestic party. Either or both or party should be non-resident, then it will be considered as an international transaction. As I mentioned, there are different categories of intangible property, tangible property, capital financing, loans, services, business restructuring, and this we have already discussed. Now, before international transaction, the question comes, what is the transaction? Now, transaction includes arrangement, understanding, or action in concert, whether such arrangement, understanding, formal or writing. Now, in many cases, there are notional transactions. Like I take an example of advertisement, marketing expense, promotion expense, where the advertisement is incurred, with the third party. I'm paying to media for those sort of advertisement. No, so in that case, the argument was taken that there is no agreement, understanding, action in concert between India and US, and whether or not arrangement, understanding, action is formal or written. So in that example, there was no arrangement, understanding, but this is litigated. And some cases, notional interest being charged, and even if there is no understanding, and coming on to this definition, I want to take one more interesting example, like receivables. Receivable from the related party. At the year end, you will see in the related party disclosure, there are receivables, accounting receivables due from related parties. Now, what happens is, suppose there are this receivable of a particular big company, suppose 10 crores of receivable or 50 crores of receivable from related party at the end of the year in the related party disclosure. Those receivables in a way are receivables. I mean, those are not actual transaction during the year. But how tax authority convert this into actual transaction is that they say to the taxpayer that you have this much of receivable, 50 crores of receivable, and you have not paid so far in the next year, as you have not received so far from your related party next year also. How can you not charge interest on those receivables, notional interest, while there is no arrangement between those receivables? There is no arrangement between two related party that the related party should pay interest, but the tax officer is saying that the taxpayer should charge interest from related party for those 50 crore receivable, some notional interest, because in a way it is a loan given by related party, a loan given by the taxpayer to related party. And if it is more than 6 months, how much is the interest you are forgiving? How much is the loss of tax revenue? And that sort of issues which are happening. And in certain cases, taxpayer making self-adjustment, suo motu adjustment of the tax return, by putting those numbers in place by in the tax return, while book value is of the interest is 0, the arm's length value is so and so based on the notional interest computation. So one need to understand that even if somewhere there is no arrangement understanding, one need to see that something out of notional things which could happen in taxpayer. And logically, transfer pricing is not only a law, as I mentioned. It's a mix of art and law, a mix of science and art as well, and it's a mix of accounting, law, and various other stuff. So this is the overall concept of the international transactions. And I'll not go into detail of, we have discussed the tangible, intangible transaction pertaining to what, and then we are discussing capital financing, provision of services. There is a concept of deemed international transaction as well. Now, this is something, a new provision, not new provision, additional provisions, in addition to the what is there existingly, that between two associated enterprise, either of them should be a non-resident. There is a deemed international transaction as well. What is that deemed international transaction? Okay, so I'll not go to the text, I'll go to directly with the example. Okay, so this deemed international transaction, there is a provision prior to Finance Act 2014, and there is a position after 2014. Now, what was happened prior to 2014 amendment? Prior to 2014, if you see, there is a Limited, which is in outside India, B Limited in India. If you see B Limited in India, and there is a C Limited, which is a third party, which is outside India. Now, if A and B Limited are anyway associated enterprise because they are group entities owning more than 26%, there is a global procurement contract between this entity and the C entity. Global procurement between A and C, and with respect to that global procurement, the transaction is happening between C and B. Now there is an agreement between A and C, and it is agreed that based on the agreement between A and C, C in INC will supply goods to B Limited at so X and X price. Okay, so there is, because of this third party agreement, C Limited is supplying goods to B Limited, and accordingly 92B2 is applicable. And because of this work, this provision, these two entities, B Limited and C Limited, become associated enterprise because there is a global arrangement in place. And when there is an arrangement in place, the price is already influenced here. And when the price is influenced, if something is delivered to by C Limited to B Limited at X price, that might be influenced, and that is called a transfer price. And even if it is between third parties, this is called a related party transaction, because this is a prior agreement between A Limited and C Limited. Now, in a similar situation, what would be the situation if this third party is in India? B Limited and C Limited, there is a procurement of goods, and because this is supplying because of the global concept. So prior to 2014 amendment, this section was not applicable. I mean, this condition was not applicable. So if any entity third party which is in India, then this deemed concept not applicable, and B Limited and C Limited are not related party. But what happens is after this 92, after 2000, after Finance Act 2014, the government has changed, and even if this is local entity, these two domestic entities are related party, but that does not consider as a domestic transaction, but considered as a related party transaction. So B Limited and C Limited would be considered as a related party transaction after after amendment in just a minute, 2014. So that one need to understand. So what is the synopsis of deemed international transaction? Transaction between enterprise and unrelated party, but there is exist a prior agreement between the related party and some third party. So because of the prior agreement, the third party is supplying to me. So third party and the Indian entity would be a related party, and one need to compute the arm's length price. Now, applicability of the Indian transfer pricing provision, we already discussed. There has to be 2 or more enterprises. Enterprises are associated enterprises. The enterprise enter into a transaction, they need to be a transaction. Transaction must be an international transaction or specified domestic transaction. Specified we are not discussing here. Value of transaction should be at arm's length price. Maintenance of prescribed documentation, they need to maintain documentation. Now there is a limit of threshold prescribed in Indian tax regulation, where if that crosses the limit, then you need to maintain the TP documentation. Then you need to file the form 3CB obtained from chartered accountant along when you file the tax return. And then there are stiff penalties provisions in the transfer pricing, strict penalties. So it's very, very important for the taxpayer to understand the importance of the transfer pricing. And not only from a compliance perspective, many taxpayer or many small company believes that transfer pricing is a compliance subject. It's a matter of filing like any other tax return. It's not. It's a matter of it's a subject where a lot of risk involved. And considering that there's a lot of risk involved, one need to see, not only the filing issues, but also see whether their policies are proper or not from a transfer pricing perspective. What the transaction they have entered, the pricing mechanism is followed. Have they done a regular health check of their policies? So that is something which is very, very crucial from a tax risk management perspective. As I said, what are the compliance for an Indian tax? Taxpayer perspective, one need to maintain documentation. If it crosses the threshold limit of, I think in India, if I'm not wrong, the threshold limit is 1 crore. If the transaction value exceed 1 crore, you need to maintain the detailed TP documentation. You need to file the accountant's report where you need to put all your transaction detail. And then there are penalties provisions if you don't do this on time. So we need to follow this provisions. Now let's come to the key part of the today's session. This how you compute the arm's length price, because this is something you cannot assume that in the third party scenario. There are mechanisms available, there are methods available, which is suggested by OECD and which is replicated in the Indian tax law. These are the methods common across the globe. In US, there are some different methods, but overall, more or less, the methods are more or less similar, that you need to follow those methods. Those are the scientific methods. And accordingly, you need to compute the arm's length price of each of the transaction. Now, looking at the time we have, what I'm going to explain you broadly how the overall transfer pricing process works by using this simple slide rather than going into the each and every section, because we have we are short of time, and it won't be possible to cover each and every slide. There are many slides left, but in the interest of the time, I'm going to discuss the entire process. So far we have discussed what is arm's length price, what is transfer price, what is controlled transaction, what is uncontrolled transaction, what is international transactions, what is transactions, what is associated enterprise. Now, after doing all these, how do you compute the arm's length price? Once you identify the intra-group transactions, what you need to do, as I said, transfer pricing is mix of business, law, tax, everything. To determining the any margin, how you determine the margin? I mean, you cannot just go to in a market and just see the price and according to apply. You need to, transfer pricing is applicable. Transfer pricing is depend upon the business of two related parties, how two related parties operate with each other. Now, I want to take a simple example of back office support services, and there is a back office support services which are provided by, there are back office services, sorry, there's something, yeah, so there are back office support services provided from Bangalore company to US company, because Bangalore is the hub of ITS. How would you compute the arm's length price of that transaction? What would be the process you will follow? So there is a transaction between two related party. Indian entity is providing back office support services to US entity, and that back office support services is provided at cost plus 15%, or you can say cost plus 15%. Whatever cost you are incurring in India, you are incurring sorry, you are incurring 15, you are adding a 15% markup. Suppose your cost during the year is 5 crore, you are adding 15% markup, and you are raising an invoice to the US counterpart. Now, how would you determine the arm's length price? Now, you cannot just go into the market and see, okay, what are the third party, other parties are doing. No, that's not the process. The process is, first, you need to understand the business of both the entities. What is the functions, assets, and risk analysis? That is the heart of transfer pricing. What functions, assets, and risk are taken by both the US and Indian entities in the transfer pricing scenario? And there are, for this back office support services, suppose US is providing some support and you are providing back office services, you need to table down all those services, and then you need to determine what is the characterization of these entities. Now, based on the characterization, you will find out that, okay, the Indian entity is a low risk. Okay, go ahead. Then what you need to do, you need to apply a method, most appropriate transfer pricing method, and there are 5 methods to determine the arm's length price. Abhishek, please let me know if we are running out of time, so accordingly I can.
No, sir. Sir, actually, we have enabled the chat box for the attendance. You can carry on till 7 p.m. No? We have 10 to 15 minutes with us.
Okay, we have more 10 to 15 minutes, right?
Around 7 we have to conclude. So you can carry on with for more than 10 to 15 minutes.
Okay, understood. God, thanks a lot. Okay. So then we have a time. So as I said, there is a back office support services, and we know the transaction between two related parties, that there is a back office support, cost plus 15%. Now I need to determine the arm's length price. How we will determine the arm's length price? First is the FAR analysis, functions, assets, and risk analysis. What functions US entity has performed? Because when you provide any services, there are functions from both sides. US entity will give some direction to you, to Indian entity, and Indian entity will again provide services. And then after noting down all those functions for two entities, you will understand what is the role of both the entities. US entity will play a major role where US is an entrepreneur and Indian entity is a service provider, and you will come to know, and you will, okay, I have done a proper analysis of the business, and based on the analysis, this is the characterization, and based on that characterization, this is my margin. Okay, sorry, based on characterization, this is my entity. So characterization is different type, like low value adding service provider, like licensed manufacturer, like distributor. So this FAR analysis which I am talking about is all about giving you the characterization, is giving you the characterization of entity, whether you are a low risk support service provider or you are a distributor or whatever, based on the business. Once you determine this, you need to apply a method how you compute the arm's length price, and I'll discuss about what are those methods. And then you determine the arm's length price, and if you feel that there is a no adjustment which is required to made, I have charged 15%, and based on the method which I have applied, the third party rate which is coming at, which is only 10%, I am providing services at 15%, so I am at arm's length. I'm giving more taxable revenue to the government, so I'm at arm's length. So then you need to accordingly conclude. Then you need to document the same, the analysis, everything. Documentation should be your FAR analysis, your method, your determination of the ALP, and if any kind of adjustment you are making, and comparability analysis, which is part of the method only. So these two are the part of the economic analysis only, which I'm talking about, how you compute the price based on use of the comparable data, which is called economic analysis. So this is the functional analysis, and the second concept where you compute the arm's length price is the economic analysis. FAR analysis we have discussed. I'm not going to discuss everything detailed, but FAR analysis more or less is the heart of transfer pricing. And FAR analysis is not, this sort of FAR analysis is not applicable in case of financial transaction, because in financial there's no product, there's no different business process. Financial is different. There's a concept of credit rating and all, but rest of the other transaction, you are a manufacturer, distributor, you need to see all these factors which is there on the screen to see whether what is the business of both the entities which are part of the related party transactions. And then you characterize whether it is a distributor, whether it is a service provider, whether it is a manufacturer or low value adding service provider. Once you determine this, then you come to the method. What is the method? That is what I say, that FAR is the heart of transfer pricing. And I'm not going to discuss detail. This is what the purpose of the FAR, that gathering the fact and functions, assets and risk, and appropriate methods. So this is the heart. And after you determine this, you will see what is the characterization. And as I said, what kind of different functions which are involved: manufacturing, research, marketing, distribution, administrative. So different characterization you will get to know after you analyze the business. And then there are, so these are the functions. And then there are two more components, because functions, assets and risk. Anything, any margin you decide, even if in a, in a general business sense, we all tell, in a business, normal business scenario as well, that the more you take risk, the more you get the return. So we cannot forget the risk part and the investment part. The investment is your assets in your business, and the assets is your plant, machinery, furniture in your related party transaction you are using. And then they are intangible. You cannot forget. You need to analyze those as well. And then there are assets, there are risks assumed as well. Now, when we talk about the risk, as I said, you cannot assume, you cannot, imagine any margin without any risk, whether it can be any entity, whether it can be US entity, whether it can be any entity, whether it can be US entity or it can be Indian entity. So you cannot imagine any margin without existence of risk. If there's no risk, how can there be a profitability? So risk is always a part of analysis. And if somebody, in my example, where the back office support services are being rendered from Bangalore or from India to US, the Indian entity is a low risk entity. It just provides services. It is not taking risk. What kind of risk? Market risk, inventory risk in case of distribution, foreign exchange risk, service liability risk. But in my example, do you think there is a risk? Market risk will be borne by US because US is an entrepreneur. India is just a back office support service provider. Having said that, given that these kind of nature of transactions, there will be less risk for one entity, more risk for another entity. Accordingly, we need to note down the risk assumed. And then these are the broad categories of risk: credit risk, market risk. Suppose credit risk, who will bear the credit risk? In my example, where the Indian entity is just providing services to related party, there are no third party transaction. Indian entity setup is just to deal with the related parties. So Indian entity is not bearing any credit risk. Entire credit risk of US, because US is dealing with the third party customers, and accordingly US is bearing the credit risk. Then there is a market risk. US is bearing the market risk. Product service liability risk. Now here there could be some sort of service liability risk which is there in the hands of Indian entity, because if you are entering into contract and if you are a service provider, there should be some sense of responsibility to deliver quality services. And having said that, there is some sort of service liability risk which is with Indian entity, but that is the only one. Technology risk, again with you, foreign exchange risk. Now foreign exchange risk might be there, but it depends upon the agreement. If the US entity is Indian entity is raising invoice in INR, then there is no foreign exchange risk, because I'm raising invoice, Indian entity is raising invoice in INR, and I'm not going to bear any foreign. But if it is in USD, there could be a challenge from a foreign exchange perspective, because who is going to bear the exchange fluctuation? Employee turnover related risk. So there are different kind of risks. These are just an example which I'm giving about risk assumed. And this is the main part before we compute, before we come into the characterization, whether it is a manufacturer, distributor, low value adding service provider, we need to see the risk involved with both the entities, not only Indian, but US, both sides we need to evaluate the risk. And this is the broad categories of risk I have discussed. Now coming on to the main part of transfer pricing methods. I'll quickly explain you how you determine. Once you determine, okay, this is a support service provider, Indian entity, which method you will apply? And I will evaluate one by one method. There are 6 methods, and most across the globe, you will see more or less you will find these methods to compute the arm's length price. 6 methods. Which method you will apply? First method is comparable uncontrolled price method. Now, this method you will use where there is a price versus price comparison. Okay, and I'm taking example simple. You are selling one goods to third party in India at rupees 100, and you are selling the same goods to your related parties at 80 rupees. Okay, so that is called a comparable uncontrolled price method, where price versus price is compared. There's no margin compared. This is very important to understand. In comparable uncontrolled price method, it is price to price which is compared, not the margin to margin. The price which is I am selling in India of a particular product 100, I'm selling the same product to related party 80, my arm's length price would be 100. This is called an internal comparable uncontrolled price method. I'm internally, I have both the prices for same product, so I will apply internal cup. And suppose if I'm selling at 100 to third party, I'm selling to 120 at related party, I'm at arm's length. I'll conclude arm's length in my books of in my return transfer pricing return. Okay, there is a concept of external cup as well. External cup means I don't have a transaction with similar transaction with third parties. So what I will do, I'll go back to some databases. So majority in India, there are third party database available where you find the details of thousands of companies, or there are third party details available on the website as well. I'll go to in a third party scenario and find out how much for the same product third party is selling to third party in the market. Okay, so that is called an external cup. So in the same product, I am not dealing with any third party, but some third party is dealing with third party. That is called an external cup. So that is called a comparable uncontrolled price method. Coming on, so in this scenario, the example which I have taken, back office support services, this comparable uncontrolled price method is mainly applicable where you have some sort of products available and you have availability of the data, price data between third party and related party. If there's no data available and if there's no product, then there is no point applying this method. In my example, there is a services, not product. And services, you cannot compare two companies for the services, because each company has a different mechanism, different quality for the services. You cannot compare price versus price in case of services. The price versus price always compared in case of product which is sold. In case of services, it is not compared. So for the services, comparable uncontrolled price method is not the appropriate method, because it is mostly applied where you have price versus price. Moving on to the next method, which is resale price method. Now, again, this method will not be applicable in my case, because this is applicable in case of distributor, resale distributors, where I am purchasing some, for example, some distribution electronic products from China, from my related parties, and I'm selling in India.
Ajit sir.
Yeah, please.
Hello.
Yeah, tell me. Yeah, Abhishek, hello. Can you hear me? Yeah, can you hear me? Yeah.
Actually, can we conclude in next 5 minutes, sir? Actually.
Okay, sure. We'll conclude in 5 minutes. So mainly, sure. Thanks a lot for this update. So mainly, I was taking example of China, but I would suggest that don't promote. I'm not promoting China. I'm just against of it. I'm just taking an example that if you are purchasing something and from some other country, and you are reselling the same as a distributor, then that is considered resale price method. And in my example, you should not use resale, because I'm a service provider. So resale price method, again, not applicable here. So this is the example which I've come, again, cost plus method. Now this, again, a third method, again, this is not applicable in case of my example, because it is this method is applicable where you have some sort of unfinished kind of services. You are providing some contract manufacturing services which is unfinished, and giving something, and they will again value add something. You are just adding some markup over the cost. But where you are delivering some final product, then this is not the right method. This is method where you are adding some margin at a gross level, But in case of my example, this is I am providing services after incurring all expenses below the GP. That's what the gross profit is not the right mechanism. I have to take the net margin and then apply method. If I take this method, I have to ignore all my expenses which I've incurred as a back office support service provider below the GP. So this is the cost plus method. This will not be applicable as it is GP. Profit split method. This is again a method where is applicable where there's a joint activities being performed, like we discussed about R&D activities between 3 countries. So again, this is a different mechanism to apply this method. This will again not applicable, because when I provide back office support services, there is no joint activities. So there are 2 entities involved, but there's no joint activity R&D performed or some joint effort. One entity is providing services. So this again not applied. This is the method which is applicable, which is called TNMM method, where profit versus profit is compared, and based on that profit, you will determine the arm's length price of the transaction, where you have a profitability in India at cost plus 15%. Yeah. And then accordingly, you run some databases, you will find the margin. And in third party scenario, if you find out that the margin is not the third party margin is 12%, you are charged 15%. This is arm's length. So in the first example, we have seen price to price comparison, that is comparable and control price. In this example, it is profit to profit, and this is what the TNMM is, and that is the most appropriate method. Now I think we have covered significant part today, and I apologize because this is a very wide subject, and it is not possible to cover everything in one day. And I would like to thank for all your patience and to hearing me. And if there is any doubt and any something we can discuss over the chat, and you can write an email also. And again, I would like to thank and also CA Abhishek for giving this opportunity.
Thank you so much, sir. We apologize from the same because we have to say to conclude. But I assure you that we will get with the new series 2 of yours, same topic in next recent days. So might be we will plan about this, that because it is a broader topic to understand, and it needs some time, and we have the VCM of 2 hours only, so we will plan for a series 2 if you allow us in next few days.
Yeah, sure. I would be happy to do that, and it would be an honor for me to share my experiences, because I belong to the same region, and I have grown up I belong to
अभिषेक जी आवाज आ रही है क्या मेरी?
हाँ सर, ऑडिबल है सर आप.
Yeah, I belong
हाँ
to,
जी.
and it would be an honor for me to do that, to share my experiences that would help all to grow further in this practice.
बिल्कुल. Thank you so much. It's a great deliberation by you, and I surely sure that our members will get benefited by your deliberation. And it's really humble, and that you have greatly deliberated all the topics and the aspects of this international taxation. So I now would like to request Dhavalji Kothari for giving the vote of thanks.
Thank you, Abhishek ji. No border is a barrier for gaining knowledge. Joy is the simplest form of gratitude. I, CA Dhaval Kothari, on behalf of Jodhpur branch of CIRC of ICI, extend a hearty vote of thanks to speaker of today's webinar, CA Ajit Kumar Jain, for wonderful deliberations and enriching our knowledge on international taxation and transfer pricing regulation. Digital taxation is a really big challenge with an opportunity for us. Thank you, sir, for enlightening us on a double taxation avoidance agreement, transfer pricing, and arm length price. A big thank you to members and virtual audience. A special thanks to our tech coordinators. I would like to request CA Ajit Kumar Jain for sharing his PPT of today's presentation. If possible, it will be really grateful for us.
Sure.
Thank you. Thank you all.
Thank you, Dhaval sir, for giving vote of thanks. Surinder sir, can you hear me, sir? Am I audible to you, sir? Surinder sir? Might be Surinder sir not getting a voice, I think. Hello, Surinder sir.
Some technical issue.
Okay. Might be there's some technical issue, so they're not able to join with the audio. So in last, I would like to, in conclusion, that I wishing all the members in advance on the CA day. That is, we are going to celebrate our 71st CA day on 1st of July 2020. So I wish each and every member, chartered accountant, a very happy CA day in advance. And because we are so proud that we have that prefix, that is the 2 letters prefix in front of name, that is C and A. It has the power, it has the dream, everything which we have prefixed in front of our name. So it's a great proud moment for all of us that we are in the fraternity of this chartered accountancy brotherhood, and this is a great moment also that we are in the 71st celebration day of our CA day. So I wish you again a happy CA day to all the members. And again want to thank CA Ajit Kumar Jain sir to sparing such valuable time with us in the branch for their VCM for this session. We hope that we will get with the series 2 of this same topic, so you can able to conclude your views and your this session
Sure.
Easily in next series. So, and I also thanks again the technical team Akshay ji and Moibur ji for handling the technical issues very well and moving this VCM forward very smoothly. And we hope that we will coming with the next few more VCMs for our members, so for able to give that platform to get the things intact of the knowledge and everything. So in last, Thank you everyone for watching this VCM patiently. So we will meeting soon in the next VCM.
Okay.
And we'll sharing all the details on the mail later on. Thank you.
Thanks a lot, Abhishek. Thanks a lot. Appreciate it.
Thank you so much. And please share the PPT on mail
I'll
ID.
share.
Will I share you?
Okay. Thank you.
Yeah.
Thanks a lot.
Okay. Thank you so much. Thank you so much.